Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include Fed rate cut odds, my interview with Polunsky Beitel Green's Peter Idziak on the Senate Parliamentarian's recent decision blocking efforts to defund the Consumer Financial Protection Bureau via reconciliation, and what markets are paying attention to with a lack of economic data to open the week.
Are you looking to cut verification costs by up to 50% while improving borrower experience and pull-through? TrueWork helps lenders streamline income and employment verification through a single VOIEA platform used by 4 of the top 5 lenders. With an industry-leading 75% completion rate, the platform consistently outperforms competitors in manual waterfalls in speed, cost, accuracy, and rep and warrant relief. They also offer free pre-approvals to help your borrowers qualify faster and only pay when a file is completed. It's used with first and second liens as well as in wholesale. It's fast to implement, easy to use, and built to drive ROI. Learn more at truework.com.
Did you know Fed Chair Jerome Powell just headed up spending $2.5 billion renovating the DC office? Yes, that's billion with a B. The chances of a Fed rate cut at its policy meeting later this month plunged to just 5% following the jobs report, because the Fed is seen as unlikely to lower its policy rate until the labor market weakens. Long-term U.S. bonds were sold off to begin the week, causing the spread between short and long-term yields to widen slightly. The movement came after President Trump signed his major economic bill to close last week and sent warning letters to countries like Japan and South Korea about potential tariffs starting next month to begin this week. With little new economic data, market sentiment was focused around trade policy, labor trends, and the potential for a new Fed chair in September. Kevin Warsh and Christopher Waller is seen as leading candidates to replace Jerome Powell. Concerns about inflation and upcoming Treasury debt sales also added pressure to bond prices yesterday. For today's interview, I wanted to welcome back to the show Polunsky Beitel Green's Peter Idziak to talk about the Senate Parliamentarian's recent decision blocking efforts to defund the Consumer Financial Protection Bureau via reconciliation and the implications for the agency's independence in the broader mortgage lending framework. He's senior associate at Polunsky Beitel Green, representing clients in all areas of residential mortgage lending, though I like to have him on the podcast for his advice on regulatory matters and compliance issues, as well as federal and state consumer financial laws and regulations.
There was a Senate Parliamentarian decision, which I had to Google what Senate Parliamentarian is. It's a nonpartisan official in the U.S. Senate who serves as the chief rules advisor to the Senate's presiding officer, which is typically the vice president or senior senator. But there was a Senate Parliamentarian decision blocking efforts to defund the Consumer Financial Protection Bureau via reconciliation. The parliamentarian doesn't vote or make policy, but the rulings carry significant influence over what legislation can move forward, especially when we have a closely divided Senate like we do right now. As I said, I've never even heard of this, but I'm hoping you can give some background about not only the Senate parliamentarians, but reconciliation, and then also what this ruling means.
Sure. So let's start with the budget reconciliation process. So it is a legislative mechanism that's designed to expedite the passage of certain fiscal policies, primarily those that affect federal spending, revenue, or the debt limit. And the reconciliation process was established under the Congressional Budget Act of 1974. So it allows Congress to align existing laws with a budget resolution. And one of the key features is it bypasses the Senate's typical 60-vote filibuster threshold. So it requires only a simple majority of 51 votes to pass the budget through reconciliation. And a key feature in the Budget Act is what's known as the Byrd Rule. And that ensures that provisions that are included in the reconciliation bill are primarily budgetary in nature and not, quote, extraneous policy changes. So to rule, a provision must directly affect federal spending or revenue, and its budgetary impact must not be, quote, merely incidental to its policy intent. Now, there are 6 issues that could render a provision extraneous under the Byrd Rule. But from what we're talking about, we really only need to look at two. One is that the provision doesn't produce a change in outlays or revenues. And the second is that it does produce a change in outlays or revenues, but that is merely incidental to the non-budgetary components of the provision. Now, as you said, who interprets this? It's the Senate Parliamentarian. They are a non-partisan, not elected, but appointed person within the Senate. So they advise on whether a provision is extraneous or not. Now, they don't enforce this. So there's been a lot of press, and I think even President Trump has sort of called out the parliamentarian for, enforcing the Byrd rule against various provisions in the one big beautiful bill. But really, it's the presiding officer of the Senate, which is either the vice president or the senior senator, that ultimately has the authority to enforce the rule. But the parliamentarian's role is critical. So they are tasked with interpreting all Senate rules, not just the Byrd rule, and they provide nonpartisan guidance. And in practice, the presiding officer will almost always follow the parliamentarian's advice. If the presiding officer disregards the parliamentarian's advice, the Senate can overrule that officer's decision with the majority vote. But this really doesn't happen because the parliamentarian's decisions are respected so much. In fact, the last time the presiding officer disregarded the parliamentarian's ruling was in 1975, so 50 years ago. And that decision was subsequently overturned by the Senate. So today you won't really even see, a presiding officer go against the parliamentarian because the Senate, for all the partisan nature of it, still is very good at sort of keeping its traditions and its interpretations intact. So let's turn to the CFPB funding issue.
Before we do the CFPB funding issue, I have a quick question about the parliamentarian, who is
Sure.
Elizabeth McDonough. She's been the parliamentarian since 2012, so long tenure. And I'm seeing here on my little Wikipedia thing, first woman to hold the position. She guided the Senate through the first and second impeachment trials of Donald Trump. Nobody remains bipartisan these days. How does it come about where, however the parliamentarian rules, it's viewed as so nonpartisan that the Senate kind of goes along with it, especially in these currently hypercharged political times?
Well, I would say that there are actually sort of a lot of officials and employees within the Senate and the House too, that at least the senators and the Congress people do see them as largely nonpartisan professionals. So how can she remain nonpartisan? I think historically what you've seen is that, she has ruled against Democratic provisions in the past and ruled against Republican provisions, in the past and now under the current one big beautiful bill. So from the senator's perspective, she's considered a nonpartisan referee. So
And I appreciate you correcting me on nonpartisan versus bipartisan. Nonpartisan is what she is. Do you have more to add there? And I cut you off. Sorry about that.
Yeah, I would just say that, you look at the fact that, she is been around since she's been the Senate parliamentarian since 2012. She was appointed by a Democrat, Harry Reid, because the Democrats held the Senate at the time. But she is respected on both sides of the aisle. And part of that is through her, longstanding professionalism. And we don't really see a lot of what the parliamentarian does. But sort of behind the scenes, she does work a lot with leadership, both of the committees and of the Senate. The idea that you would just replace the parliamentarian with someone who is maybe considered more partisan, who would give you the interpretations that you want, would just mean that, should, let's say, the Democrats come, they would do the same thing. And so that's why you sort of don't see that happening.
Well, as a quick follow-up, and I've gotten us sidetracked already, but she was appointed under Harry Reid, who's a Democrat. Is she just not on Trump's radar for the thought of replacing her, or the position's viewed as so nonpartisan that it's not even something that would kind of be?
Well, it's this. So she is a employee within the within Congress. So President Trump lacks the authority to hire and fire her. She is not someone who is part of the executive branch.
Understood. Okay. Well, I cut you off in your original answer. Let's get to the CFPB funding mechanism. Can you kind of give an overview of why this ended up on her desk and what the ruling was?
In the initial Senate bill, there was a provision introduced by the Senate Banking Committee that would have reduced the maximum amount that the CFPB may request from the Fed. Currently, it stands at 12% of the Fed's 2009 operating expenses, and that's then adjusted for inflation. They would have amended it down to 0%. And the parliamentarian ruled that that provision violated the Byrd Rule. Now, the parliamentarian does not publish her reasoning, so sometimes we're left to guess or sort of read the tea leaves or see what a senator might say to have an idea of what the reason was. However, here, based on comments made by Senator Tim Scott, who's the chair of the Senate Banking Committee, we can assume that the parliamentarian rejected this initial proposal because the reducing it down to 0% would have affected the statutory functions of the Bureau. So probably under that earlier reason that this provision produces a change in outlays or revenues, but it's merely incidental to the non-budgetary components of the provision. So that initial 0% reduction or reduction down to 0% was ruled extraneous. So the Republicans then worked with the parliamentarian and introduced an amended provision that reduces the funding cap down to 6.5% of the Fed's operating budget. And that seems to have been approved by the parliamentarian. So in the press release announcing this, the Republicans on the Senate Banking Committee announced that this reduction would not affect the statutory functions of the Bureau.
Well, they may claim that, but I have to ask you how you think it'll shape future regulatory oversight in the mortgage space or the CFPB's operations and those sorts of things moving forward.
Well, it's interesting. So, because outside of this reconciliation process and reducing the budget, we also have what is sort of happening at the CFPB right now. So in the immediate term, this reduction that much. So in fiscal year 2024, the CFPB's cap was about $800 million. And of that, the CFPB under Rohit Chopra requested about $755 million. So about 95% of the existing cap. So let's say the Senate version of the 6.5% cap comes into play. Well, for fiscal year 2025, that would reduce the budget, the max budget request down to $448 million. So as you can see, significant reduction in the ability of the CFPB to function there. And that $755 million for 2024, the largest single expenditure was about $480 million on employee compensation. And at the time, the CFPB had, at the end of fiscal year 2024, had about 1,700 staff. So that's sort of the background. But let's look at what's happening now. We have Acting Director Russ Vought, who came in, and in February of 2025, he reviewed the Bureau's finances, and he determined that because the Bureau had an existing balance of about $711 million in its Consumer Financial Protection Fund, that he felt that he did not need to request any additional funds for fiscal year 2025, so the entire year, to carry out the authorities of the Bureau. And beyond that, we have the current lawsuit that's been filed by the National Treasury Employees Union, basically to stop the Bureau and Director Vought from reducing the staff down to what his plan is to be about 200 people. So I would say that at least under sort of current directorship of Vought, that he is not going to come anywhere near this cap and is going to try and be far under it. So in the immediate term, we might not see much of an impact. Now, where you will see any impact is in the future. So let's say in 2028, we have a Democratic administration, they appoint, a Democratic director, and they seek to sort of spin back up the Bureau. Well, you're not going to get back to your 1,700 staff. You're not going to get anywhere near that. So any attempts to sort of reconstitute the Bureau in the future will run into this funding cap. Now, an interesting thing to think about, though, is that all that's been done through reconciliation is a reduction in the maximum budget of the CFPB. The legislation can't, because it's outside the budgetary process, affect any of the authorities that the CFPB has to enforce existing consumer financial protection laws. It doesn't, seek to, through congressional action, force the Bureau to prioritize or deprioritize any aspect of consumer lending. So in the future, a director could still sort of allocate his or her reduced budget to those enforcement and supervision priorities that they still see as important.
Yeah, I think that's a great point that even if the CFPB has this budget, they're likely not going to use it under the current acting director. That's important for people to note. And I should add the caveat here, whatever your answer is for this next question, you're not giving legal advice, but I want to ask how lenders should recalibrate, if at all, based on this ruling, kind of implications for the mortgage industry. And maybe if there aren't many, you kind of roll that into the CFPB's evolving enforcement posture and how you view it currently.
Yeah, I think this ruling itself, and let's assume that it goes through at the Senate number, which is 6.5%. And I should mention that in the House version that was introduced, they reduced the cap down to 5% for fiscal year 2026 and forward. So, assume that it lands somewhere between 5 and 6.5%. So let's say that it's about, a haircut of 50% of the CFPB's existing max budget. Right now, again, I don't think that has much of an impact for how lenders should recalibrate their compliance strategies. I think what a lender really should look at are the priorities that were announced by Acting Director Vogt for 2025. So if I'm looking at, if I'm a compliance officer for a lender and I'm looking at the world today, I don't think I'd really spend much time thinking about how a reduction in the budget might necessarily affect the CFPB and how they will interact with me. I would look more towards the announced priorities by the current administration.
Defunding is obviously off the table now. Full defunding, it's gonna be 5% or 6.5%, or it's not gonna be zero. Put it that way.
Right.
What are the other threats currently to the Bureau's authority or continuity? And maybe that's too obvious. Maybe there's an obvious answer, and I don't mean to kind of reduce it to that or be reductive. But when it comes to further threats to the CFPB beyond what we've already seen, what kind of existential crises exist out there for the Bureau?
Well, there are, in sort of the budgetary context, there are a few cases that are sort of working their way through the system that attack the Bureau's ability to draw funds from the Fed when the Fed is not turning a profit. So the statute says that the CFPB funds must come out of the Fed's earnings, and there's a debate amongst what does earnings mean? Does that mean just simply revenue, or does it mean profit? So that is out there and is currently a challenge sort of working its way through the system. I will say, in my own personal opinion, I'm not sure that that those that argue that earnings means profits and that, since I think it's September 2022, any funds the Bureau has had, are not constitutionally appropriated, is not necessarily a winner. Beyond that, the two main sort of areas that opponents of the CFPB have gone after are the areas of authority for the Bureau and sort of the source of funds. So one effort has always been to bring the Bureau under the annual appropriations process. And that is clearly something that cannot be done through reconciliation. So it would require 60 votes in the Senate to happen. Right now with the makeup 53-47 for the Republicans, I don't think that that's likely to happen. I don't think Senator Warren would ever allow that to happen. And similarly, in the areas of enforcement, same thing. Until you're getting 60 votes, at least on paper, the Bureau going forward will be able to draw, let's say, 5 or 6.5% of the Fed's operating expenses. So, about half its current maximum potential budget, and, enforce the same areas of consumer financial protection. So existentially, I think, at least in its structure, the Bureau will continue on. The big question is, under Acting Director Vogt and the Trump administration, who clearly is not a fan of the Bureau, what will the Bureau actually be doing during the next 4 years? Will we see actual enforcement and supervision that align with the announced priorities, or are they sort of just going to operate the Bureau, sort of bare bones, doing the statutorily minimum required work? Are you going to then see a lot of, potential actions from, let's say, consumer groups that are, sue the Bureau and basically say, you are not enforcing the law? So I think, in the next during the Trump administration, that's really where going to be the focus is not how much money the Bureau can necessarily have in its budget, but what is the Bureau doing day to day? And then sort of the second part of that is state attorney generals and in certain consumer financial laws, private rights of action are available. So what states are going to sort of pick up the slack? What areas are they going to focus on? So I think that'll be sort of the interesting thing going forward. And then, of course, we have, and it'll be interesting to see how this plays out, but the recent Supreme Court decision that limited the ability of district court judges to issue nationwide injunctions. So are you going to end up in a world where, the consumer financial laws, the federal consumer financial laws, are in effect in certain areas and not in effect in others? So, the upshot is we could see a much more fractured, supervising enforcement environment for the next 3 to 4 years.
Which I, for one, don't necessarily think is a good thing for the mortgage industry. If you're licensed in all 50 states, trying to figure out a myriad of different rules and regulations is no fun. It's just going to increase compliance costs and ultimately costs.
Yeah, I was talking to a state regulator, and I said, whenever you're enforcing a federal rule like a CFPB rule, do you ever call them up and get their interpretation? And he said, well, yeah, it's their rule, so I'm going to sort of go along with them. And the question becomes, well, whenever there's no one to call, or the Bureau has sort of ceded the field, are you going to see let's say Democratic AGs that take that opportunity to come up with their own interpretations and pursue those? So it could lead to a more expensive compliance environment overall, even though the costs of complying with federal CFPB oversight might go down. And I want to say you could see an uptick in cost, even though probably the overall compliance costs will go down with a reduced CFPB.
Yeah, it's certainly become a messier landscape in a lot of senses. I appreciate you helping decode some of what's going on. Always a pleasure speaking with you. So thank you for making the time, Peter.
My pleasure, Robbie.
NFIB Small Business Optimism for June kicked off today's economic calendar. And it's a fairly uneventful day from a data perspective, with other releases limited to Redbook same-store sales, consumer credit for May, the New York Fed's consumer expectations for June, and Treasury activity that will be headlined by an auction of $58 billion of 3-year notes. We begin Tuesday with agency MBS prices slightly worse than Monday's close, the 2-year yielding 3.90, and the 10-year yielding 4.41 after closing yesterday at 4.39%. Let's wrap up with a joke and some housekeeping. The CNN news photographer quickly used a cell phone at the local airport to charter a flight. He was told a twin-engine plane would be waiting for him at the airport. Arriving at the airfield, he spotted a plane warming up outside a hangar, so he jumped in with his bag, slammed the door shut, and shouted, "Let's go." The pilot taxied out, swung the plane into the wind, and took off. Once in the air, the photographer instructed the pilot, "Fly over the valley and make low passes so I can take pictures of the fires on the hillsides." "Why?" asked the pilot. "Because I'm a photographer for CNN," he responded, "and I need to get some close-up shots." The pilot was strangely silent and then finally stammered, "So what you're telling me is you're not my flight instructor?"
Thanks again to TrueWork, the only all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings with an industry-leading 75% completion rate. To learn more, visit truework.com.